Trump's decisive victory opens the way for a dramatic reorientation of US policy, including a reversal of climate change policy, deregulation, tax cuts, all of which will have far-reaching effects. And I will discuss some of these, but in this week's market perspectives, I want to focus on the impact on tariffs. And during the election campaign, President-elect Trump vowed to increase tariffs on Chinese imports to 60%, more than double their current level, impose 100% tariffs on imported vehicles and Chinese imports routed via third countries such as Mexico and Vietnam, plus a 10 or even 20% tariff on all other imports. Well, that would represent a massive change. Now, the general market view is that there will be big exceptions to the tariffs, even on China, and that the threat of across-the-board tariffs will largely be used as a negotiating tool to secure concessions, both political and economic, from other countries. I think the market is being too complacent. The political pendulum that's been swinging away from free trade since the global financial crisis, at least. And indeed, President Biden, he retained most of the tariffs imposed by Trump in his first term. There will be important effects on individual companies and on sectors. The movement away from free trade will surely harm economic growth over the long term. And while the direct effects on US inflation might seem limited, once again, most market analysts could be underestimating the impact. Now, it's true that the US is a relatively closed economy, and even a wide-ranging tariff would exclude services and many commodities. So the direct effect of, say, a 10% tariff might be to raise consumer prices by considerably less than 1 percentage point. But domestic producers, well, they would raise their prices in the face of reduced competition from overseas, and given the strength of demand in the US economy, likely to be bolstered by further tax cuts, that will increase the pace of pass-through, which will also include a pass-through to wages. Indeed, the market is already pricing in significantly higher US inflation over the next couple of years or so. Now, the Federal Reserve tends to look through one-off price increases, but this could be quite significant, and either way, it would slow the pace of rate cuts. When it comes to US GDP, well, that would be damaged by reduced access to cheap imports, but assisted by reduced competition from abroad. The net effect likely to be modest in the near term, but if protectionism continues, the loss of gains from trade would dominate. Now, retaliation from foreign countries outside the US, that's probably going to be limited. When it comes to China, there's been a process of disengagement by the US for some time. Europe, well, that would probably suffer significantly, and even a modest hit to growth would be painful given the weakness of the economy there. But experience from Trump's first term suggests that retaliation will be quite limited, looking at iconic brands such as Harley-Davidson and Bourbon. Now, the UK economy would be less affected given we have a smaller manufacturing sector, but we'd also be less able to negotiate concessions given our relatively small size. The special relationship might matter little, and the much-discussed free trade deal, well, that would require concessions on agricultural imports that British consumers and its EU partners would find hard to digest, if you forgive the pun. Even if Trump does relent on tariffs on exports from the EU, he would seek concessions on areas like the regulation of US tech companies. All in all, it looks like China would suffer most, the authorities there would respond with more stimulus, the EU would suffer next, and the UK relatively little. And the stock market? Well, US companies' profit margins, particularly the domestic sector, would be boosted by the tariffs, and a cut in corporate taxes would provide a further boost. Companies exporting to the US, well, they would be harmed. Despite the unpopularity of globalization at the political level, it has raised consumer incomes and corporate profitability, so the long-run effects are likely to be negative. But all in all, I don't think the tariffs will kill the bull market in equities. I do think the first 180 days will see a burst of policy changes from the incoming administration. They're emboldened by their electoral victory, and are keen to reverse as many of Joe Biden's policies as they can. As Al Jolson said over 100 years ago, you ain't seen nothing yet. I'll be on holiday next week, and one of my colleagues will be filling this slot. So it's goodbye for now from me.